All right, welcome everybody. I'm curious to know how many of you have already gotten a binder to put all the in-class exercises in? Some of you have done that already. Good. You know, the other thing you can put in it besides the in-class exercises that I'm going to be working through with you during our class meetings is the lecture notes. And so if you go to Blackboard and in this subfolder lecture notes, all of the notes through the entire semester are available in a variety of different formats. So if you want to save paper and you prefer to have 6 of these slides on a page, we wait just a moment. All right, here it is. So, 6 slides per page, or if you want to have a little extra space to take notes, writing in the margins, then maybe you just would want 3 per page. And so you can just choose whichever format works best for you and print it out and include it in your notebook along with the in-class exercises. So I'd encourage you to look over that in our class webpage. The other thing I wanted to point out is that the homework assignment, remember you have to submit your assignment using Blackboard, and it's available on Blackboard. So I'm going to be giving you a lot of paper this semester, but what I won't give you is a paper copy of the homework assignments. So if you just click on the PDF, then you'll see the homework assignment. The first few questions are kind of like getting to know you type questions where I'm interested to know a little bit about your background and what are your strengths when it comes to studying, and what are some learning methods that you work well with, that sort of thing. And then the rest of it is problem solving related to the stuff that we began on Monday. So that assignment is available now and is due a week from this coming Friday. So it's due on Friday the 24th of January, homework assignment number 1. Anybody tried Cam Scanner yet? Yeah? Some of the veterans in the back have used it for several semesters now. They know how it works. All right. Well, let me know if you have any questions as you're working through that assignment. It's really a good strategy to not wait until Thursday the 23rd to work on that assignment. It's smarter on your part to do it while it's still fresh in your mind. If we do an in-class exercise today that is kind of like the intro to a problem you're going to solve in homework 1, you'll be able to solve that question on homework 1, the corresponding question, a lot faster today than in 8 days when you've kind of forgotten the basics of what you did in class. So I really think that it's a great strategy to try and read in advance, like look through the homework assignment, and then when we do a part of the in-class exercise that will help you with that, then take it from there. Here's an open seat right here. Any announcement questions? Okay. Well, last time we talked about interest rates and we solved some problems. We had to rush through that third problem, the one with the currency conversion. So if you didn't get a chance to solve that part of the in-class exercise, I'd encourage you to look back on the YouTube video and make sure that the solution, because the solution is included in the screen capture from the YouTube video, make sure that you can follow that, where there's both the interest part of it and also the currency conversion part of it. What we're going to do today is talk about different types of accounts that pay interest, because the different type of account is used for different things and it pays sometimes widely varying interest rates. So a checking account, for instance, is where you typically put money that you're going to need in the short term. And so it's for purchases and withdrawals by either debit card, checks, ATM withdrawals, and some checking accounts pay interest, but not usually very much. I've got a savings account right now that pays, I've got a checking account that pays interest, but it only pays 0.01% interest. So that means that if I put $100 into an account that's paying 0.01%, at the end of the year, I'm getting a penny. So it's not really anything to speak of. Whereas a savings account, by contrast, you'd use a savings account for money that you're not going to use in the short term. And so it's maybe you'd have 2 or 3 transactions in a month if you're going to move the money in there to earn a little more interest, or move it from the savings to the checking once you get low in the checking. By contrast to the 0.01% I make in my checking account, I have a savings account that makes 1.8%. And so that's a lot more, although it's still not very good, because I remember a day back in 2007 when I had a savings account that was paying 5.6%. So that was a huge difference. Back in 2007, interest rates were high, but they're low now. But the thing about a savings account is that you can't write checks against it. It's pretty uncommon to have an ATM card that would be directly linked to a savings account. And in fact, there are sometimes rules in place with the bank that you can only have a certain number of transactions each month with a savings account. And the reason for that is that they're going to be paying you a higher interest rate. They need to have more stability in that supply of money, because they're using your money for other things. That's why they're paying you interest, is because they'll get a deposit from you and loan that same money to someone else, and they keep the difference between what they're paying you and what they're taking from the other person. So if they take your $1,000 and loan it to someone, they may pay you 1.8% on that amount that you deposited, whereas that other person's maybe buying a car with it and they have to pay 6% interest on the amount that they've borrowed from the bank. And so then the bank keeps the difference. And so the thing is they can't have you taking money out of the savings account too often. They don't want so much turnover in that account. And so that's why there are rules and incentives in place to try and reduce the frequency of transactions when it comes to a savings account. Does that concept make sense to everybody? Are there any questions about checking versus savings accounts? Now, money market and CDs are taking the stability of the money supply to a next level. Now, a money market account is kind of a hybrid between a checking and a savings account. There are money market accounts where you're allowed to write checks from the money market account, and there are money market accounts that have a plastic debit card that's associated with it. And so it's kind of a blend between checking and savings, but still they're intended for people who aren't going to have as many transactions as checking accounts. And so it may be that you can write a check against money market accounts, but it's not typically an unlimited number of checks that could be written. A CD, by contrast, is a contract between you and the bank that you're going to leave the money in the account for a fixed duration. And so a 1-month CD means that during that 1-month period, the amount that you've given to the bank, you promise not to withdraw it. And because you're promising to leave that money in there, and it's more stable for the bank, and so that they're able to loan it out with more assurances that you're not going to need it anytime soon, they pay a higher interest rate for CDs than they would on a savings account. And so there are certificates of deposit for a whole wide range of durations. There may be a 1-month CD all the way up to a 10-year CD, where people are putting money into an account and promising the bank that they won't take it out for 10 years. And then if they do, there's generally a pretty big penalty that you have to pay. You're forfeiting some of the interest that you would have otherwise earned if you would withdraw early from a CD. And having that stability, the bank knowing that they have your deposit available to them to loan out, allows them to make longer duration loans. And so if they had CDs from people, they maybe feel comfortable to make a home loan, which is going to be repaid after 30 years, compared to an auto loan, which is maybe only going to be repaid during a 5-year period. And so if the bank is going to be giving the money to someone else for a long time, then the money that's coming into them, they have to know that it's going to be on deposit for a longer duration. So the difference between a debit and a credit card, even though it's plastic that you carry in your wallet and it can be used in the same places, the difference is that when you're spending money that's linked to a debit card, you're spending your money, and it comes directly out of your checking account on an immediate basis or within 1 or 2 days. But a credit card, when you spend money with a credit card, you're spending the money's bank. Excuse me, you're spending the bank's money. It's not your money that's being spent. You promise to repay it, and some people will repay the full amount every month to avoid interest charges. Other people, if they just pay the minimum amount that's due each month, you can have a credit card purchase that takes you years and years to repay and be quite a lot more expensive because of the minimum finance charges and the interest. The thing about a credit card is that when you're spending that money, it's an unsecured loan. Unsecured means that the bank doesn't have any collateral other than your promise to repay. And so think about the types of things that you purchase with a credit card. Sometimes it's a bigger ticket item, like maybe the down payment on a car could potentially go on a credit card, although that would be a pretty bad decision because the interest rates are so high. Maybe you buy a refrigerator with a credit card, and if you didn't pay the bank back, in theory, the bank could take you to court and get a court authorization to repossess your refrigerator. But think about how inconvenient that would be for them to come into your house and lug out a big heavy refrigerator that's full of food, and they just wouldn't want to deal with that. And there's plenty of things that you buy with a credit card that they'd never be able to repossess anyway, like your lunch. You know, like they're not going to be able to repossess the sandwich that you bought for lunch. And so it's an unsecured loan, and it's so convenient just having this line of credit available to you on a piece of plastic. The banks generally charge really high interest rates. Interest rates maybe, if you have some special promotional rate and you're a preferred customer, maybe 16% per year. But they go up from there. 29, 30% wouldn't be unheard of on an annual basis for a credit card. And the largest part of the reason why the interest rates are so high is because it's unsecured. There's no collateral.
So I just had two quick questions. One is that, so if you have a interest rate for, say, like a credit card where it's high and it compounds annually, if you were to pay it off monthly, would there be like any compounding of interest? Or?
That's a great question. Although credit card interest rates are expressed on an annual basis, so let's say that you have a credit card that's 24% per year. The way that they compound it is on a monthly basis, and so they're expressing it on an annual basis just because that's what we're used to hearing is percentages on an annual basis. But then the monthly would be that annual rate divided by 12. And so really what happens is if you pay it off in full every month, there's no interest. But if you took 2 months to pay, then you'd have 2% interest charge each month that you borrowed the money.
Okay, and then the second one was, so when you're talking about big ticket items, rather with a credit card, where you'd be purchasing, say, a refrigerator, like you said, that was reasonable.
Yeah.
So what's the point, I mean, this is maybe a stupid question, but what's the point where repossession, the whole process would cost the bank more than it's worth to repossess the item, and would they still do it on the principle of the issue?
Right.
For, you know, because you can't create a loophole.
That's an interesting question. I think it probably varies from bank to bank, and it probably varies from location to location, and if they have an idea of what you bought. So let's say, for instance, that you've got a credit card with a $20,000 limit, and you bought jewelry with it. It would be easy for them to repossess jewelry because it's light, and presumably you either have it on your person or it's in a secure spot where if there's a court order, then they're going to be able to get at it. And so maybe a bank would be more prone to go after jewelry compared to something that's heavy or doesn't hold its value. You know, another thing is, like, say, a widescreen TV, whereas the jewelry is still going to be worth pretty much what it was when it was initially purchased because gold doesn't wear out, diamonds don't wear out. You know, a flat screen TV, a used flat screen TV, they're not going to be able to really do much with it. Sell it to a pawn shop, I don't know. So it probably varies from place to place, but most of the time, rather than try and go after the item, what a credit card company would do is garnish your wages. And so they would get a court order to make your employer put a certain amount of your paycheck into their account. And so you wouldn't get your full amount that you worked for. I think that's what credit card companies would do more frequently than repossession. cars and auto loans, those are different. Repossession is more common in those cases, but with a credit card, my sense is that it's not that frequent. Those are great questions. Other questions? All right. Mortgage and home equity loans are secured. That means that there's something the bank could take, some item with high value that they could get back, and so the interest rates are lower because it's less risk to them. In the case of the credit card, there's more risk, so the interest rate is higher. In the case of a mortgage loan or a home equity loan, there's less risk because they have a legal right to own your house if you don't pay back the loan. And your house has a stable value. Homes don't wear out very quickly. So over the life even of a 30-year loan, the home is likely to hold its value or even increase and appreciate in value over time. So the difference between a mortgage loan and home equity is that a mortgage loan is used for the initial purchase of the home, but a home equity loan is usually once you have some equity, meaning if the house is worth $100,000 and you only owe the bank $60,000 on that house, then you have $40,000 worth of equity. So the equity is like the amount of the house's value that you own. So if you have some equity in a property, you can borrow against that equity. You can pledge the amount of the home's value that you own to get another loan. You already owe the original bank a certain amount for the mortgage, but the equity, you can get a home equity loan and then use that to consolidate other purchases. Like if you had a bunch of credit card debt and you're paying 30% on that credit card, then it would make sense to take a home equity loan and pay off the credit cards, because home equity loans have a much better interest rate. Maybe 6% would be a typical home equity loan interest rate. So it would be a lot better to have 6% owed than 30%. Sometimes people use home equity loans for medical expenses or home improvements. So there's a variety of different things available, but what they share in common is that they're secured. Okay. We're going to look at this figure a couple of times this semester, and it's going to become increasingly complex. It's simple right now, and there's an important lesson that you need to learn right now while it's simple, but then later on in future lectures I'm going to add additional elements to this figure, and its interpretation and its meaning will evolve. But right now what you can see is that there's a trend. If we consider the axes, first of all, on the horizontal axis, it's the cumulative amount. And what this means is it's the cumulative amount that's borrowed. So for a certain person or company, and since this is millions of dollars, let's assume it's a company. A company is borrowing money in order to do something new. Like maybe they need to borrow money to buy equipment for a new project. And the annual rate is talking about the interest rate that the lender is going to charge whoever's borrowing the money. So look at the trend. The annual rate is going up as the cumulative amount borrowed increases. So this semester you're going to have concept questions on quizzes and exams. A lot of it's going to be problem solving, but you're also going to have concept questions. And sometimes it'll just be a picture. And I'll ask you, describe this picture, or tell me the interpretation or the story behind this picture. So what do you suppose is the story, or what's the trend that's being illustrated here? Anybody want to take a stab at it? I mean, there's no pressure. You've never seen this figure before, and you've got no reason to know it yet. But what speculation have you got on why, when the cumulative amount borrowed increases, why would the interest rate go up? Yeah.
Since they borrow more money, they're going to increase the interest because it's a larger amount of money.
But why? You're right. That is so. Okay, I'm glad you put it that way. So he said because you borrowed more amount of money, the interest rate is going to go higher. And that's true, but we need to go one step beyond that and get to like the why of it. So you have to be careful that you're not just like in your response kind of describing the trend, because he did a great job describing the trend, but also explain why it exists and what's happening. Yeah?
Is it like a larger risk to pay it back?
Okay, there's more risk. You're right. It's because of more risk. Now, describe the risk. Who is facing the risk, and why does it exist?
The person they borrowed from, that's who has the risk.
Okay, so the lender is experiencing the risk.
If they never pay it back, then, you know, they want you to pay more interest.
Okay.
As the more you borrow gets larger.
All right. Is there another way to put it?
If they don't get paid back, the more that was borrowed in the first place, the more the loaning corporation loses.
Okay. So great information so far. So the lender has a bigger loss if they don't get paid back. If it's $7 million, that's really going to sting. Well, $1 million, that's not so bad, right? It's still kind of bad, but is there another trend? Go ahead.
Would the value of money depreciate by the time they got it returned to them? And that's why they didn't do it?
Okay, that's an interesting point. And she brings up a really important issue, and that is maybe it takes longer to pay back a $7 million loan than a $1 million loan. And that may be true. But let's assume, just for simplification, that right now all of these loan durations are the same. So that the interest rate is only about the risk and not about the repayment duration. Because it could, a bigger loan could take longer to pay off. But I'm saying that this trend could exist even if all of these loans were being paid back over the same time frame. I think there's one more aspect that we haven't quite hit on yet.
Is it because the bank can't use that money for other purposes?
That's true, and the more it is, the less that's in. We call that opportunity cost, that if you gave $7 million to person A, you can't give that $7 million to person B. So we've already agreed it's about risk, and the more money there's more risk. But like, why is there more risk? Like, why is it more risky? Think about just now one company. Like, I have a company and I'm making steel pipe. So I take sheets of steel and I'm turning it into steel pipe. If I borrow $1 million, maybe the bank looks at what I do. They know my customers. They know how much business I did last year. They know all that stuff because I have to tell them when I'm applying for the loan. They look at my balance sheet, my projects, my history, and they say, based on your risk, we want 10%. But now me, that same company, I asked for $2 million. And they're not too badly fazed by that because they know my background. And so $2 million is about 10% again. But now I, the same company, ask for $7 million. They're a little more nervous now that I've asked for $7 million. And so they perceive that that's a greater risk because they're less convinced I'm going to be able to repay it. So the more a single entity borrows, the greater the risk is that you won't be able to repay. So this can apply in your personal life as well. If you are buying a home, sometimes there's what's called jumbo loans. If you want to live in a big McMansion that has like 8 bedrooms and 12 bathrooms and like a sewing room and a weight room, like if you want a really big house because you're living the American dream, chances are if you just have an ordinary job and you're going to be like spending every last penny you've got on your mortgage, you're going to have a higher interest rate because the bank looks at your situation and says, this guy's going to be one paycheck away from being out on the streets, based on the savings you've got, based on your job history. Like if you get laid off, then you don't have the income to cover that huge house payment. But if you live in a more modest home and more reasonable expenses, then losing your job for a couple of months until you can get back on your feet isn't going to be a big issue. It's not going to bankrupt you in the same way as if you had that big expensive house. So that's the trend that we're seeing here when it comes to borrowing money. It's true that borrowing more means the bank is going to lose opportunities for other things. And it's true that borrowing more may have a longer time period, but the main factor here is just the more you borrow, the greater the risk of non-payment is. And so here's how I put it. And this isn't in your notes, so I encourage you to write it down in the margins if you're able to take notes. The cumulative amount borrowed increases, the risk goes up of a borrower not being able to repay. Since there's more risk, then the lender wants to earn a higher rate of return. So if I was going to ask you to tell me a story about this picture, or like summarize the trend in a quiz or an exam, this would be a good response for that image. Yeah.
If we were to respond and say like something not like more specific, if we say like a man borrows from a bank and as the man borrows more, the bank has a higher rate because of more risk, would that be a fine response too?
Well, I'd want to know if, like in that particular example, I want to know why is it more risk.
Okay.
I mean, you're right, but like continue the story and tell me more about the man and how the bank is at more risk because he borrowed more.
Yeah.
Maybe it's because suddenly his mortgage payment is closer to the entirety of what he makes in a month.
Mm-hmm.
If you make $5,000 a month and your mortgage payment is $1,000, that's probably not too bad. You've got money left over for other things. But if your mortgage is $4,000 and you're making $5,000, that's like you're right on the razor's edge. So here, the main phrase is not being able to repay. That's the risk. The risk is that the borrower won't be able to repay. And why? It's because whatever their income is getting closer and closer to the interest amount, to the amount they have to give to the bank. So, I mean, if we go back to the example of housing, I've heard it said that most banks consider 40% of your gross income to be a reasonable limit of how much you should have as your mortgage payment each month. So if you're making $1,000 a month in income before taxes, before deductions, then the bank wouldn't want you to have a loan payment more than $400. So 40% of your before taxes income. Okay, so that's all for the concepts and discussion type stuff. What I'm going to give you now is our in-class exercise, where on the front page of the paper I'm asking you to go through some like short answer and kind of thought-related questions. And then on the back side of the paper is some calculations that extend the ideas that we did on Monday. So remember, when we do these in-class exercises, this is informal time for you to talk with your classmates. It doesn't need to be quiet. It doesn't need to be like we're in church or something. If you want to use your calculators for the problems, that's good. Sometimes, occasionally, I'll ask you questions where you have to like do research online. I don't think that's the case today, but I'll be circulating around with the solution in case you want to check your work. %, attendance today. I like that. That's good. We're all here. It's a full house. All right, let's talk about the first page, the front side. So we have a table of interest rates going from lowest to highest. And these are different products that the bank offers. And the thing that's kind of interesting is that the two things at the top of the list are where the bank is paying interest, and everything else is where the bank is receiving interest. And so now look at the percentage rates. On the products where the bank is paying interest, the interest rate is the lowest. But when they're receiving the interest, the rate is the highest. It's not a coincidence, right? If they're the ones getting the money, they want I to be big. And if they're the ones paying the money, they want I to be small. That's how they make their living, is by splitting the difference there. All right, so why is the savings account the lowest? I said because that's where they're paying the interest. And then in contrast to the CD, in the case of a savings account, there's no restriction on when it's withdrawn. So you may have put it a different way, but the main idea is just that their incentive is to minimize the amount of interest that they pay. All right, question number 2 is about the CD. Now the difference between that and the savings account is that in the case of a CD, you have to agree to keep the money with the bank for a certain amount of time. So, in terms of guiding your expectations for what's a good answer and what's a bad answer on a quiz or an exam would be to say a CD is a certificate of deposit. That's defining the term, but it's not explaining what it is. Question?
Just a generalization, like how long would a CD last, and like how much do people, like, on average put in?
That's a good question. Often CDs will have a minimum amount that you're allowed to put in. And so, typical CD minimums would be 1,000 or sometimes 5,000. And one strategy that a lot of people use is called laddering. And so if a bank offers a 1-year CD, a 2-year CD, a 3-year CD, let's say that I've got $100,000, and I'm not exactly sure when I'm going to need it, but I know I'm not going to need it within the next 1 year. A typical strategy is to put like some of it in a 1-year CD, some in a 2-year CD, to like stagger it so that every year a certain amount is maturing, so that if you need that amount you can use it, and if you don't, then you'd renew it. The amount that just came due this year, you'd kick that into a 5-year, and so every year one of the amounts is coming due. And so that's called CD laddering. But how much people put in, it's really, you have to know when are you going to need the funds. So if you're in college and you've got a tuition payment due, then probably a CD wouldn't be a good idea. But if you're planning for your kids' college and they don't go to school for 5 years, then maybe a 5-year CD would be a good place to put the money. Was there a question in the back?
I'm just going to ask you after class.
Okay, that's fine. All right, so here in C, why might a mortgage rate be higher for a 30-year loan compared to a 15-year loan? All right, there's 2 different elements of risk. One of them we've talked about and another one we haven't. We have talked about how there's a risk of non-payment. And so, like if I'm buying something and it's taking me 30 years to pay it back, there's a greater risk that I won't repay over a 30-year period. There's just more uncertainty. Maybe my employment, the skills that I have will get stale in a 30-year period and I won't be employable anymore. Like if I don't do any continuing education or something. So that's one part of it, is there's a greater risk of non-payment. So that's one type of risk that the bank faces. But another is called interest rate risk. And interest rate risk is related to opportunity cost. So think about the money that the bank gives you for your house. It's tied up in that loan for a long time. And it might be that suddenly the interest rate environment goes up, so that they could have loaned it out to someone else for a greater interest rate than they loaned it to you, and now they've got that opportunity cost. And so in 30 years there's a greater chance that interest rates could go up, and then here they have this loan that they're only earning 6% on, when they could have earned 10% from someone else. We'll talk more about interest rate risk, but I identified two reasons. One, the risk of non-payment and the risk of interest rate changes. Auto loans are secured, but it's secured with property that loses value compared to a home that generally appreciates in value. So that's why there's higher interest rates, is there's more risk, and the reason why there's more risk is that the collateral is getting less valuable. Yeah.
So, just sidebar from what you said about homes.
Mhm.
What do home equity loans or mortgages look like in an area where, say, you have a large urban environment and a certain area is kind of at the front of where violence has been spreading?
Yeah.
And a couple looks for a house there. Would that be? I mean, because then there's a huge chance that house drops in value due to, you know.
Mm-hmm. Yeah, there would be a higher interest rate, and those places like urban areas that are kind of in the inner city is someplace that subprime loans happen a lot. And during the financial crisis around 2008 or so, there were a lot of people in inner city areas that got talked into shady loans from banks that were unethical, with really high interest rates that people couldn't keep up on the payments, and then they repossessed the homes. And so it is an issue that, you know, some neighborhoods, it's not just all about you. Sometimes it's related to where you're buying the property, if it's a risky geographic spot. All right, let me show you the solution to those calculation problems on the back. Let's see if we're all on the same page with how to do those. We've just got 2 minutes left. I think we can double check. All right, so for the first one, the answer was $111,000. So you can see that what we're doing is we're just substituting into this formula that tells you the future amount based on an initial present value, the interest rate, and the number of years that compounding occurred. This is kind of an early first glance at something that we'll spend a lot more time on, but I wanted to see if you could utilize those equations to find F given P. Okay, so the first one, 111,000, and the second one, the answer was 4.97%. Now that one's tricky. I mean, if you have equation solving in your calculator, I think in 111, you should have learned how to solve for unknowns using the equation writer in the calculator, the Casio. We'll get into this as well, finding an unknown interest rate. But before we wrap up, since we're running out of time, let me just revisit the announcement slide and remind you that homework is due on a week from Friday. So the effective student who wants an A or a B in the class, a good strategy is to work on the homework, to start on it tonight, because you've just done some in-class exercise problems that will inform how you solve those problems. Get an early start. All right, I'll see you on Friday.